Hey everybody, Jordan Schwartz here with Strategic Wealth Designers, and today we're talking about life insurance, what's good, what's bad, and where it fits in your portfolio. Okay, so we're talking about life insurance. So there's two primary types of life insurance that we can look at. We can look at term and then whole life. Now, term is for a period of time. Typically it's, maybe 15-year term, 20-year term. It's the cheapest way to get life insurance, so a lot of people do that if they've got young kids or a family or a mortgage they've got to pay for. The other type, and this is the one I really want to focus on today, is whole life insurance. Now, there's a lot of different types of whole life insurance. We've got index universal life, variable universal life, whole life. We have all these different types of whole life insurance. So what we've got to figure out then, and what most people traditionally think of old school life insurance, is whole life. Well, there's two different things that we should focus on whenever we're thinking about life insurance, two different numbers. The first one is death benefit. The second one is cash value. So what do those mean? Well, death benefit is the amount of money that you receive or that your loved ones receive if you pass away. Death benefit is great if you're trying to cover something for your kids, like I mentioned. Maybe you've got a mortgage and you don't want a spouse to have to worry about it, or you're trying to cover some of your burial costs. Now, the other number right here is cash value. Cash value is very important because within the life insurance policy, when you're paying premiums or money into that policy, typical term life, you pay money, you never see that cash you put in again. With whole life insurance, you actually have that cash value that you can see and you can access. Now, the reason why most people don't like life insurance is because it's not structured properly. This is the biggest element I want you all to take away, is that if we structure life insurance properly, it can be a great tool. If we don't, it's why you hear a lot of negative stigmas about it. So what most people typically historically have done is with their life insurance policy, they want the highest death benefit possible and the lowest cash value. Now, when you do this to a life insurance policy, you essentially have such a high death benefit, there's a cost to that. And the cost of insurance eats away at this cash value where that money can never grow, perform, and build. What we want to do is we want to flip it. We want instead the lowest death benefit possible and the highest cash value possible. Now, without getting too technical and too overly complex with this, what we want to do is we've got to make sure there's a very narrow corridor with this. And what we want to make sure that we do not do is MEC the policy. It stands for Modified Endowment Contract. It's going to mess up some of the tax advantages of life insurance. I'll talk about in a minute. So we want to lower the death benefit as much as possible and raise the cash value. When you do this, if we've got a lower death benefit, the cost of insurance is much less, which then allows for that cash value to grow, perform, and build. Now, there's three primary benefits to a typical whole life or permanent life insurance strategy. The first one obviously is our death benefit, right? Death benefit is great if you're trying to cover some different properties or beneficiaries, heirs, anything like that. What we want to make sure though that we're doing though with this death benefit is that it's structured appropriately and it's structured accordingly. The second thing that we're looking for within the life insurance policy is we have what is called, if structured properly, an accelerated death benefit, right? Accelerated death benefit. It's technically a long-term care, in a way, a supplement that covers some of your long-term care needs. So basically, if you look at long-term care, it's crazy expensive right now. Probably next 15, 20 years, most people won't even use long-term care. They'll have supplements attached to a life insurance policy. So what we want to do is within this life insurance strategy, what we can do with the accelerated death benefit is we can access 1/4 of the death benefit. So simple example, let's say that somebody has a $400,000 life insurance policy, meaning that if they passed away, their loved ones would receive a $400,000 death benefit. So what we've got to make sure that we're very careful within on this long-term care supplement is that within the rules of life insurance or any long-term care policy, you have what's called your activities of daily living, right? Activities of daily living. And basically what that means is if you can't complete 2 of those 6 activities of daily living, a long-term care event is triggered. Now, those activities could be dressing, bathing, eating, sleeping, caring for incontinence, using the restroom. Those 6 different things, and if we can't complete 2 of those 6, a long-term care event is triggered. When that trigger happens with the long-term care event, what we have access to with this strategy is we can access 100% tax-free, 1/4 of the death benefit, or in this case, $100,000 over a 4-year period. Now, the reason why this number is so important is if you typically look at the cost of long-term care today, generally it's between $50,000 to $100,000 a year that we'll need. A normal long-term care event lasts between 3 to 5 years, which means we've got the average number of care that we could potentially need for long-term care. Now, the third benefit, and this is probably the big one out of all of them, is the tax-free nature. Make sure you all write this down, take notes on your phone, whatever you need to, because this is huge right here. So we've got our death benefit. That covers how much our loved ones receive when we pass. We've got our accelerated death benefit, which is how much long-term care we can get. Now, we know within the life insurance policy itself, it can grow when the market grows, it can be tied to different indexes, or it can get just a straight up amount that a group of people decide what the rate is on that, typically a fixed rate. And then as well, the third piece that we have is tax-free. Now, within the IRS code, there's a rule that allows loans, not withdrawals, but loans from a life insurance policy to be tax-free. Well, the nice thing about this law and this rule is that we never have to repay that loan back in the future. Basically, what happens is, do a little bit of simple math. Let's say that from this you pulled out $50,000 from the cash value. Well, you do the math, $400,000 on the death benefit minus the $50,000, which is the loan that we took, means that your loved ones, heirs, and beneficiaries receive $350,000. Now, the reason why this is so unbelievably important is there's only 3 types of truly tax-free investments. We've got Roth IRAs, municipal bonds, and investment-grade life insurance. This strategy just like this. So these are the 3 different benefits you can create for life insurance that can add a massive difference to the success of how your portfolio is going to look. Now, one thing I want to mention too is, well, who the heck does this make sense for? Who should have this, who shouldn't have it? And I think there's 2 primary groups that we should be looking at whenever we think of who needs life insurance like this and who doesn't. First and foremost, we'll call this our young accumulators. These are people who are starting out, they're growing, they're building their wealth. Maybe they have young children, they just bought a house, or they have a lot of debts that they have to pay, maybe student loans. This life insurance tool could be great for them because if they passed away, that death benefit goes to take care of their family. And also, let's say that they don't need the money for a while, well, that cash value has built and grown. The other group that we could look at is the pre-retirees. And the pre-retirees, this could make sense because if we think about it, taxes are probably gonna have to be higher in the future. Trillions of dollars of money spent, debt issued, all the concerns that we have as a nation, our expenses, there are going to have to be some sort of precautions that come into play in the future to cover the need and the cost of what's potentially going to happen with rising taxes. So the pre-retirees, and what's so unbelievably important about this is we need to make sure that this group of people is paying attention when it comes to taxes. You can't print trillions of dollars, have really high expenses like America does, and not expect there to be tax impacts in the future. Well, what a lot of pre-retirees and retirees can do is convert their IRA accounts, 401ks, 403bs, and potentially look at moving that to tax-free and a tool like this to put themselves in the position where their taxes aren't as much. Now, those are the 2 different ways, and if you have more questions or you'd like to see awesome videos just like this, you can give us a call. You can send us an email at info@swdgroup.com. Make sure that you subscribe, like the video, and we'll love to see you soon for some more videos.